Hi guys, my name is Tom. Welcome to this week's video on explaining the term out of the money in relation to option contracts. Over the course of weeks and months, we are going to teach different option terms, strategies, and techniques to our viewers. Our ultimate goal is to educate you about the wonderful and highly profitable world of option trading. As always, don't forget to click the link and subscribe to this page. You'll also receive alerts when they are posted. Please also check us out on social media. We're active on Instagram, Twitter, and Facebook. So let's jump into this week's topic and explain the term out of the money. Before we do that, let's do a quick refresher on what are options. So options are contracts that give the bearer the right, but not the obligation to either buy or sell an amount of some underlying asset at a predetermined price at or before the contract's expiration date. Option contracts are financial agreements between two parties to facilitate a potential transaction on an underlying security at a set price called strike price prior to an expiration date. When you buy an option contract, you can choose to either exercise your option contract on or before the expiration date, or simply allow the option to expire unexercised. Options are an example of derivative. A derivative's price is dependent on or derived from the price of something else. Wine is a derivative of grapes. Fruit juice is a derivative of the underlying fruit. Then finally, options are a derivative of stocks. One option is called a contract, and each contract represents 100 shares of the underlying stock. So what is the term out of the money? Well, the term out of the money is trying to focus on the underlying strike price of the option contract relative to the current market value of the underlying stock. Out of the money situations affect the intrinsic value of the option. The amount of time remaining before the option contract expires also plays a role in the value of the option. This in turn affects the premium the buyer is willing to pay. And an out of the money option is simple. It's one when the strike price has yet to reach the underlying stock price, meaning there is no value to this current option contract. It doesn't mean won't have any value in the future, but if it was to expire right now, this option contract has no value. It's worthless. Buying an out of the money option is viewed as like an aggressive choice. Because these options have a greater chance of finishing out of the money at expiration. Out of the money options carry zero intrinsic value and are much more susceptible to negative effects of time decay. The trade-off to these negative effects is the cost of the entry is lower. You're buying an option contract that has no value at the moment. You're hoping that the price moves up or down depending on if it's a call or put. You're hoping a significant price movement is going to happen. And that's why it's called an aggressive choice. You need the market to react. You can't let it stagnate. Therefore, also every single option contract is affected by time decay. If the option underlying stock is not moving, it's getting closer and closer, you're more susceptible to this negative effect of time decay. The chance of significant price movement up or down in your direction becomes less and less and less. The big trade-off to all this is that it's cheaper. You're probably making money is less. Therefore, the cost to get into this position is significantly less. So it's a gamble. And I always think about buying an out of the money option contract and in the money option contract about betting on the best teams in a sport. The best teams have the better odds. They have more chance of winning. Therefore, they will cost more to get in or pay out less. And then the underdog or the worst teams, they're really, really cheap to get into, or they'll either pay out more because the probability of them making money is less. That's the same concept with being in the money and out of the money. So let's jump into a brokerage account and see where out of the money is an option chain and show you, the investor, how to identify it in your brokerage platform. So we've jumped into our brokerage platform, and today we're looking at JP Morgan Chase, a very popular bank and massive bank in America and around the world. And what we're looking at is an option chain or option matrix, strike price, expiration at the top. And what we're focusing on this week is out of the money. So out of the money means it has no value. And more importantly, it has no extrinsic value. I mentioned numerous times about the 4 quadrants of an option chain if you have looking at calls and puts. Previous video, we talked about in the money. In the money calls here, below the underlying stock price. In the money puts above the current underlying stock price. Now, let's look at out of the money option contracts. Here, as a call, we want it to, go below it. These ones are above. Therefore, they are out of the money. Puts, we want it to go high. Down below, these ones are out of the money. And if your brokerage platform doesn't display the different shading, you can identify it in 2 ways. Number one, looking at the current stock price and seeing where it wants to go. We know with calls, we make money if the stock rises above our strike price. If the strike price goes before, like here, if we have a strike price here and that is 102, we won't make any money. Therefore, there's no intrinsic value and it's not worth anything. And puts, it's the opposite. One thing you want to look at is the extrinsic value column. Extrinsic value. In the money, there is a number associated with it because it has value. This extrinsic value is the difference between the underlying stock price and the strike price. 1.2 minus 9.8, 4.7, 102 minus 100, 2.7. As we gradually approach the 1.277, it's less and less. And as soon as the one indicator strike price interval ticks over above that 102.7 mark into 1.3, we lose the extrinsic value. So there's no extrinsic value on this. Same for the puts, it's opposite. As we're approaching 107 is the difference between 107 minus 102, 4.2, getting lower, 103 minus 2.7, 0.2. So in here, there's no extrinsic value. Therefore, it's out of the money. So that is where out of the money sits in your option chain and explaining what it means. If you're holding an option contract at expiration and is out of the money, it is worthless. It holds no value. Thank you so much for watching this week's video on out of the money in regards to option trading. If you like this video, please check out our website at the link. Please also check us out on social media and please subscribe to this YouTube channel. Stay tuned for new content next week. Thank you so much.